If you have 50 lakh rupees, 1 crore rupees or more to invest, you may have asked yourself this question: why should I pay a SEBI registered investment advisor? Why not simply give the money to a PMS and let them manage everything? It sounds like a fair question. A PMS looks convenient. A professional team manages the portfolio, buys and sells on your behalf, and you do not have to make every decision yourself. So, then why do some investors still choose to work with an RIA? That is exactly what we will understand in this video. Hello, I am Sujith SS from Moneydhan Investment Advisory India LLP, a SEBI Registered Investment Advisor. At Moneydhan, our work is not to push products. Our job is to help clients make better financial decisions based on their goals, risk capacity, timeline, and existing portfolio. And today, let us break this down very simply. First, the shortest possible answer: APMS manages a portfolio and RIA advises a person or family. That one difference changes everything. A PMS is usually about managing a pool of money that you allocate to that strategy. And RIA looks at your broader situation first. Before deciding whether PMS is right or wrong for you, and RIA asks questions like: what are your financial goals? How much money do you actually need in the next 2, 3 or 5 years? How much equity risk can you truly handle? What do you already own across mutual funds, stocks, insurance, deposits, gold or property? Are you already overexposed to one theme, one manager or one style? And most importantly, should a PMS even be a part of your portfolio? That is the first big difference. A PMS may answer: how should this 50 lakh rupees or 1 crore rupees be managed? An RII first answers: should this 50 lakh rupees or 1 crore rupees even go into a PMS? Let us take a simple example. Suppose you have 1.5 crore rupees available for investment. Now, one approach is this: you hear about a PMS with a good track record, write a check for 50 lakh rupees or 1 crore rupees, and let them manage that allocation. But another approach is to first ask: how much of this money should remain in equity? How much should stay liquid? How much should go into debt? Do you need any of this money within the next few years? Is your emergency reserve already in place? Do you already hold enough direct equity or active funds? Will this PMS create unnecessary overlap with what I already own? This is where the role of an RIA becomes valuable. Because sometimes the correct answer is not yes, take PMS. Sometimes the correct answer is allocate only a smaller amount to PMS. Postpone PMS for now. Use simpler products first or avoid it completely. That is why this is not a returns conversation alone. It is a decision quality conversation. What a PMS actually does, a PMS or portfolio management service, is designed to manage money on your behalf according to a stated investment strategy. Typically, investors use PMS when they want a professionally managed market-linked portfolio and are comfortable delegating day-to-day investment decisions. In most cases, when people talk about PMS, they are referring to discretionary PMS. That means the portfolio manager can take buy and sell decisions within the agreed mandate without asking you before every transaction. This gives you convenience. But it also means that once you have chosen the PMS, you are placing a lot of trust in that strategy, that manager and that framework. Also, PMS is not for tiny ticket sizes. The minimum entry threshold is much higher than ordinary mutual fund investing, which already tells you that the product is meant for a more specific investor profile. So, PMS is not a bad. It is simply one portfolio solution not a complete financial solution. What an RIA actually does. Now let us talk about an RIA. A SEBI Registered Investment Advisor is not supposed to function like a product seller. The advisory role is about understanding your overall financial life, toned, then recommending what is suitable for you. That may include asset allocation, portfolio review, goal based planning, risk alignment, product selection, rebalancing, and ongoing decision support. An RIA can recommend mutual funds, direct equity, debt products, cash allocation, or in some situations even suggest that a PMS may be suitable for a part of your portfolio. So, an RIA is not competing with a PMS in every case. Very often, an RIA helps you decide whether to use PMS, how much to allocate to it, and where it fits in your total portfolio. That is a far more strategic role. So, who has more control? This is another major difference. With an RIA relationship, you remain much more involved in the decision process. You get advice, you understand the rationale, you choose how to act on it. Your money remains under your control and the implementation follows your approval. With PMS, you are deliberately giving up some degree of control in exchange for convenience and delegated execution. Neither is automatically better. The right question is, do you want advice with control or do you want portfolio management with delegation? Some investors prefer full control and want to understand every move. Others do not want to track markets, research managers, or handle ongoing portfolio decisions themselves. So, the answer depends on your temperament as much as your balance sheet. A mistake many investors make. A lot of investors compare RIA and PMS only on one basis. Which one gives higher returns? That comparison is incomplete because the two are not always trying to solve the same problem. A PMS can be excellent and still be unsuitable for you. Why? Because suitability is not just about performance. It is also about your time horizon, liquidity needs, tax position, existing holdings, concentration risk, emotional ability to handle volatility, and how this decision fits into your broader plan. A portfolio that looks attractive in isolation may be completely inappropriate when viewed in the context of your full wealth. That is why an investor should not start with the product. The investor should start with the plan. At Moneydhan, that is exactly how we think. We begin with the investor, not the product. Can an investor use both? Absolutely. This is important to understand. It is not RIA versus PMS in every situation. Sometimes the best structure is RIA plus PMS. For example, an investor may work with an RIA for overall strategy, asset allocation, portfolio review, discipline, and ongoing decision making, while using a PMS for one specific part of the equity allocation. In that case, the PMS is not replacing the advisor. The PMS is one tool inside a broader framework. And that framework is what keeps the overall portfolio sensible. Without that broader view, many investors end up collecting products instead of building portfolios. So, who should consider an RIA? An RIA may be particularly useful if you want a complete view of your finances. You have multiple existing investments and want clarity. You do not want product push based guidance. You want someone to evaluate suitability before recommendation. You want accountability in financial decision making, or you want professional advice without handing over blind control. This becomes even more valuable for families where money is spread across direct stocks, mutual funds, old insurance products, deposits, PMS interests, and legacy holdings. Because in real life, investors usually do not have one neat product problem, they have a portfolio structure problem. And that is where advisory becomes meaningful. So, who should consider PMS? PMS may be worth evaluating if you have sufficient investable capital, you understand the risks of active market linked management, you are comfortable with delegated decisions, and you are clear that this is one part of your portfolio, not automatically your entire financial solution. A good PMS may play a useful role for the right investor, but the key phrase is for the right investor, and determining that is exactly why the advisory lens matters. Final thought. So, if you are asking why should I pay an RIA if I can just give money to a PMS? Here is the answer. Because a PMS manages money and RIA helps you make better financial decisions. A PMS may tell you how to manage an allocation, and RIA helps you decide whether that allocation should exist in the first place. A PMS can be a product solution, and RIA is a decision framework. And in wealth creation, the quality of the decision often matters more than the excitement of the product. If you want help reviewing whether your current portfolio, mutual funds, direct stocks, or even a potential PMS allocation actually fits your goals and risk profile, you can explore our process at moneydhan.com. At Moneydhan, we focus on thoughtful, fee only, advice led investing, not product pushing, not noise, not random portfolio activity, just clearer decisions, better structure, and more discipline. If you found this video useful, do share it with someone who is trying to decide between an RIA and a PMS. Thank you for watching. Want a second opinion on your portfolio? Visit moneydhan.com.